Do you trade against the trend?
Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial market and incredible guests. I am Matheus Massari and I am extremely excited to be here. With me, I have Flavio Lemos.
Good morning, good afternoon, or good evening, where you might be around the world. I am Flavio Lemos, president of Brazilian local chapter of the CMT Association, also author of some investment books. I have just completed 50 years old, a half a center of life, and we are speaking English because we want to show inspire new traders around the world. I hope you will like it and spread our word.
Great. I'm certain that we'll have an amazing conversation with our guest. Speaking of our guest today, he has a 50-year investment career as a technical analyst, a developer of indicators and trading system. His investing career began over 50 years ago at a multi-billion-dollar pension and profit-sharing money management fund, where he was ultimately tasked with researching strategies to improve the company's investment timing. Disenchanted with the concept available at the time, he began developing his proprietary models that would become the hallmark of his career. Flavio, do you know him for a while, right?
His studies and indicators are followed by traders and analysts around the world. Some of his awesome indicators were also included in my last bestseller book. He is the author of some books as New Market Timing Techniques, The New Science of Technical Analysis, and of course, the mark on the trading option.
So let's run against the trend with this trader. He has been called the ultimate indicators and systems guy. Throughout his career, he has focused on defining objective and mechanical approach, and in 2020, the CMT Association officially selected him to receive the CMT Annual Award. But only now, in 2023, they were able to host an event worth of this tribute. So please welcome Mr. Tom DeMark.
Well, thank you very much for the invitation, and I'm looking forward to our conversation.
Okay, once again, congratulations, Tom. Thank you so much for being here. Your passion, creativity, curious, and fearlessness in timing the market is unparalleled, and I cannot think of anyone more deserving the CMT Annual Award. Your knowledge is of immeasurable value to new generations. So please thank your beloved wife, Nancy, and all your family for being here.
Appreciate it. You're very kind.
So you have presented your tools of tech analysis around the world, but what was more difficult? Through a ceremonial first pitch ball at the New York Mets game, or winning the CMT Annual Award?
That's funny you should say that. The New York Mets game was something that was arranged by the owner, Steve Cohen. Steve and I have been working together for 28 years. I speak to him every day, and I provide special insight to him for him and his group regarding the markets. He's very proficient in the indicators I created. And when he bought the Mets, even prior to buying the Mets, he said, "I want you to throw the first pitch out." And I couldn't do it the first year. And then obviously with COVID, I balked. You might say that's a baseball term. But I said, no, I'll do it the first time I get to New York in 2023. And that's what I did. I arranged it that the Mets pitch. And Steve was kind enough to give me the opportunity. He also gave me the owner's boxes, and he was there as well at the game. And I was able to have 50 to 75 of my close business associates. They were there as well. A number of large fund managers like Leon Cooperman and David Goel and John Burbank and people like that. They were there, and as well as other people that media people with whom I've worked with throughout the years. They were there. And then 2 days later was the MTA annual award. And I was fortunate enough to receive the 50th anniversary award. And Steve attended that as well, which is unusual because Steve never misses the close in the stock market. And he did that one time. He said it was the first time in 25 years he missed the closing because there was a conflict with the award ceremony and the stock market being open. So it's really a toss up. I had the opportunity to meet all my friends that, whom I've known for the last 5+ decades, and we all socialized together. And then we had the MT Annual Award, which is special to me because I've dedicated my entire life, both professionally and personally, to market analysis. And so the combination of two couldn't have been better. And
You
my
deserve
family
it.
there too. I'm sorry,
You
what?
deserve it, Tom. Thank you.
Well, thank you very much. I put in a lot of time and effort into this, and we still have that same goal to decode the stock market and decode all markets. We have a staff. My son runs the business at the office, and he's got 26, 27 employees, and they're all dedicated to research. And we've created some special research services which we share with the world, really. A lot of previously proprietary. He has a service called Symbolic, SYMBOLIK. It's a charting service, but it includes all the indicators of that, many of the most popular indicators I created. So we're still making a big effort, and we can look forward to doing that in decades to come.
So, Tom, tell us about your beginning as a technical analyst. You found that technical analysis often conjured negative images among the investment community, and you repackaged your work as market timing. So, up from the start, you are a lawyer. So, how did you discover technical analysis?
Well, in the 1960s, after I graduated from college, I went to law school, and during that summer, I worked at in the offices of a major company in Milwaukee, Wisconsin, and two of the people there had a keen interest in the stock market. One followed point and figure charts. This is back in late 1960s. The other one followed bar charts, and Abe Cohen had a point and figure chart book, and Bill Giler had the stock market chart book. And they introduced me to it, and I just fell in love. And then, fortunately, I did not complete law school. I broke my back while I was in law school. So I migrated over to the MBA program, and I got my master's in business. And from there, I was fortunate enough to land, you might say, at the fastest growing fund in the country. And we managed about $3 billion, $4 billion, which was a lot of money back then. And there were only 9 of us professionals who did it. Most of the people there were CPAs, lawyers, and attorneys. And 2 of the people there also had an interest in technical analysis, but it wasn't well received back then. Our president was one of the founders of the Chartered Financial Analysts Institute in Charlottesville, Virginia, and he was a pure fundamentalist, but he tolerated the other 2 and myself, technicians. But the other workers there were pure fundamentalists. So it wasn't well received, and I've described it at the time. I had my chart books. I always hid them in my drawer because it was almost like having a Playboy magazine at a monastery. You know, it was heresy to have a chart book because a lot of the investment community didn't believe in it. And back then, in the early 1970s, late 1960s, there really wasn't much other than basic technical analysis, and that was primarily moving averages and trend lines and some indicators that were overbought, you might say, and oversold, and they were derived from odd lot short sales and specialist short sales and things like that, statistics like that. So it was all crude. So I took it upon myself to research as much as I could, and fortunately, because our company was so large, I had a large commission budget, and I was able to dole commission dollars out to the Wall Street firms, and I got introduced to all the technicians, or most all technicians on Wall Street. And then I also had an interest in the retail side of the business, and that's where I met people such as Larry Williams, and this is all Larry Williams is primarily the most dominant individual back then, and he still is. So he and I began a friendship at that time. So it was, and the reason I refer to our work more as market timing as opposed to technical analysis is because technical analysis that still has a little bit of a bad edge to it. Market timing, people seem to accept it better, and our approach to analyzing the market is less trend following, and it's more associated with trend exhaustion. See, because I was raised in the institutional side of the business, we didn't have the luxury of buying at market lows or after a bottom was formed, and we didn't have the luxury of selling at a market top or just after a top was formed, because our positions would be too large. So I had to anticipate when a market bottom might occur and when a market top might occur. So all my indicators that I created were developed with that in mind, and selling into strength and buying into weakness. And that's all part of this basic concept I've always had. And I was able to prove this mathematically. Markets bottom, and people have this notion that markets bottom because there are a lot of smart buyers at the bottom, and or there's groups of people that work together and operate together to make a market bottom, and that's the furthest thing from the truth. Market bottoms are made because the last seller, figuratively speaking, has sold at that point, and by default, the market goes up with a little bit of buying. And conversely, at market tops, it's not because of smart sellers, it's because the last buyer, figuratively speaking, is bought, and there's no one else left to buy, you might say, and by default, prices come down. So that's the whole theory of our approach, and that's what we call market timing, as opposed to technical analysis, even though it's a department of technical analysis.
How many indicators and setups you develop? Could you talk about some of them?
Oh, there have been quite a few. I mean, like I said, my whole life has been devoted to this, 7 days a week, 24 hours a day. And then when you have a staff, see, I was fortunate. I had the resources of this big fund, and I was able at that time, but see, most of the work I did was all original work, and it was using crude tools such as proportional divider, a ruler, you might call it a straight edge, things like that. And we didn't even have calculators back then. This was pre-Bowmar calculators. It was pre-Texas Instruments. So everything was done manually. And but we did have resources. We had an agreement or contract with a division or department at Harvard University, but that required that delays in getting our analysis, our analytics. Nothing was done quickly back then. There was first class mail, but there was no overnight delivery, and so we were really determined to do our own research because we had no other option. So we back then, like I said, I did what most people did, I think, who were really interested, and there weren't that many on the institutional side of the business, but I sought out everybody who had any good ideas, original ideas, but I found most of the creative people were on the retail side of the market, more specifically the commodity side. And that's where I met Larry Williams over 5 decades ago. And he was the most creative of all. And he and I established a very close relationship, which still exists through today. And he and I collaborated on a lot of things, and he guided me back then. And like I said, I was fortunate. I had both directions covered, institutional and retail. And that's most people were solely retail or solely institutional, but I had both because of my interest in research. So how many indicators? I mean, there's in the toolbox that we have for symbolic, there's probably 100, and most of those have been validated. There are quite a few. I mean, they're not conventional indicators. I mean, and we can get into it. And I have a few charts I wanted to show you because of the success we had with some of these indicators. They've survived, you might say. Sequential was created back in the mid 70s. Combo was created just shortly afterwards, and they've survived, and they've proven their effectiveness over all these decades, and there hasn't been much change to them. Now we've enhanced both those indicators, but those, as far as moving averages and trend lines, we've got those approaches as well, which are conventional. But we do everything in a systematic approach. We're totally objective. We don't like using subjective analysis. When I wrote my first book, I said a chartist, you could break down a chartist, the word, into a chart artist. And anybody that's an artist is subjective. So I identified three different gradations, you might call, or levels of analysis for a technician. The first one is look at a chart and you conclude if the market's going up or down, and most of it is, I mean, it's totally subjective. One day you might look at the market at a particular chart and you say the market's going up, and a month later you look at the same chart and you say it's going down. And a lot of that decision making is influenced by your who's ever sitting next to you, people you talk to, the news, or you're affected by all variables, stimuli outside the market. The second level of analysis is indicators, and that's where we operate. We operate at an indicator level because we want to make certain that what I conclude today is going to be the same as I conclude looking at the same chart a month, 2 months, a year from now. And those indicators would be the same as if two people were using the same indicators, they would pretty often just arrive at the same decisions. So there'd be consistency. The third level of analysis is systematic approach. You would take the indicators and you would improve upon them, and you make them a system. And that way there's no interference at all by the trader. It's all done by computer. And that's what we're doing right now. We've been conducting tests for 3 years with the fellow who is the head of quant analysis at Bank of America and his staff, and they work on staff with us. So, but I mean, we've always operated at the indicator level, and we do have a lot of indicators. And just about 3-4 months ago, we created another one, which we thought we think has a lot of potential. But we want to see what happens over the next year to see how effective it is and continues to be. But we do a lot of testing. We got data way back in time, and we've created indicators all the time. So it's not something that's static. I
Okay.
don't know if that answers your question, but there are quite a
Yeah.
few.
You
Symbolic's
answered
got 100.
two questions in a row. That's great.
I'm sorry, what?
No, you have answered 2 questions in a row because I was just about to ask you how you develop the TD sequence and TD combo, and you talk about it.
Well, I can tell you, I mean, there's times when you get an inspiration, like with sequential. I was working with Fibonacci numbers back in the early 1970s. This group by the name of Bank Credit Analyst wrote about one of their research people discussed the Elliott wave. And nobody knew Elliott wave back then. And he said that the Elliott wave operates on this principle, which is it's dominant in nature, and it's based upon the golden mean and blah blah blah. So what I did was call the publisher, a fellow by the name of Tony Beck. He was in the Bahamas, and they had 2 offices in Toronto. And I contacted him and I said, "Can I speak to your research guy?" Hamilton Bolton was the name. He said, "No, you can't. He died." He said, "But I can give you some other person who I think could help you if you're interested in this type of analysis." He said, "I'm a fundamentalist, but I could direct you." So he directed me to a traveling tax judge in Canada. And I called the guy, and the guy's name was Jack Frost, just like the mythical character that appears during the fall, winter, and paints the leaves with frost. And I said, "Hey, Jack," I said, "I'm interested in Elliott wave. Can you help me out and explain it?" He said, "Well, I'm an expert, but I'm a traveling tax judge, and I don't have time for you." So he referred me to two physicians down in Florida, and one of them, the fellow by the name of Dr. Wiley, he was in Wildwood, Florida. I contacted him and I said, "Do you know anything about Fibonacci and the Elliott wave?" He said, "Oh yeah." He said, "I live and breathe it." He said, "I'm more interested in that than my medical practice." He said, "I give you the number series," and he said, "I could." He said, "If you want me to give a presentation to your group, I'd be happy to come. But the only time he could come would be on a Friday, late afternoon, evening." So I went to pick him up at the airport, and he wasn't there. I thought, and all the people, the other 8 professionals of my company were waiting on a Friday night, and they had canceled their social activities to meet this supposed expert because I talked them up. And I was walking up and down the concourse at the airport, and I was worried this guy didn't show, and he was coming in from Eastern Airlines. So I called his office, and they were an hour ahead of me, and I was afraid I wouldn't be able to reach anybody, but I did reach his nurse or his receptionist in his office. I says, Dr. Wiley isn't here. She says, oh no, he's there. Don't worry, he'll find you. And then I was walking up and down the concourse at the airport, and some guy with a long white beard came up to me and he says, you're Tom DeMark. And I said, yeah. And he said, do you know how I know? And I said, no. He says, you're walking in Fibonacci angles. So I had to bring this person into the office, and it was very embarrassing. I mean, it really was. The guy started talking, and he said, I know Fibonacci and Elliott, and he had data going back to the mid 1800s, and he says, there are different waves in the market. There's 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233. I sound like, 377. And it was embarrassing. So I came back to work the following, I was stuck with this guy for the weekend. And I went to work on Monday. I thought I'd be fired. And these guys said, we appreciate your interest in exploring different new avenues, but make certain you're more circumspect in the future and you don't get lost with these crackpots. And I said, okay. So Jack Frost gave me another doctor's name. His name is Ledbetter. He was in Merritt Island, Florida. Merritt Island, yeah. And I contacted his office and I spoke to his nurse and said, what did you want? And I said, what's it regarding? I said, Elliott Fibonacci and Elliott Wave. And she said, let me get him if he's interested. He picked up the phone and he said to me, he said, oh, I love Fibonacci. He said, I've been married 5 times. I have 8 kids, and every 13 days I take a vacation. So what I found is that there are really goofy people out there, just like I was, that were really interested in the markets and were obsessed with it. But you don't want to get involved with these people because there's no progress, no potential. So, excuse me, what I did from then on, I decided I'm going to do my own work. So I studied all about Fibonacci and Elliott Wave and angles. Like the angle of the pyramid of Gizeh is at 61.8%. That's the golden mean. So I studied all that, and then I incorporated these into my idea and how the market's top and bottom. And I looked at comparisons of closing price, the current bar versus 5 bars earlier, 3 bars earlier, which are Fibonacci. And I finally decided to close current bar versus 4 ago. And once I've accumulated 9 of them, markets seem to react. But I said, this does not reconcile with true Fibonacci because you got 9 and 4 instead of 8 and 5. But then when I looked at it further, if you take 9 and 4 together, that equals 13. So I did satisfy some of the requirements on Fibonacci, and then once I've recorded those 9s, and I'll show you with the charts, it evolves into further trend movements in the direction oftentimes, and that's when you incorporate a comparison of 13s. So I did that. Larry Williams was involved. Larry was active, and after I created Sequential, we were both researching it. I moved forward with something called Combo, and Combo is more exact, and that really is a derivation or was inspired by Sequential. But we got a number of different versions of it, and that's how I created it. It was more hit or miss. I mean, nowadays you can do things a lot faster than I could. Everything I did back then was with a magnifying glass and subscribing to all the charting services and having access to things that most people didn't have. But so I was able to create those, and those are really the 2 key indicators. And excuse me, I was surprised to learn, and that's how we got these charts to show you. These are actual 9s and 13s, we call them, on Bitcoin. Back in 2008, 9, and 10, Steve Cohen, whom I had worked with for so long, had wanted to buy into the company a number of times, and we just never came to terms. Another individual by the name of John Burbank from Passport Capital was managing $4 or $5 billion, and he had a very successful 2-year period in 2008, 2009. He approached me and wanted to buy it, and so both of them bought into the company. And John was brought to our attention in about 2017. He said, you might want to look at cryptocurrencies, and we didn't have data, so we just kind of dismissed it. But instead, we went ahead, he kept encouraging us. We got the data and we looked at the data and we could not believe that 13s and 9s were appearing on the day of the exact high, top and bottom of the market. And we'll show you that. And I think in the last 5-6 years, it's become widely used by Bitcoin and crypto traders. If you go on the internet and just type in DeMark and crypto or DeMark and Bitcoin, you'll see that a lot of people are following the 9s and 13s just because of the success we had. We were surprised how well that market, our indicators adapted to the exact highs and lows of that market. And we believe because there's really no fundamental source of information for cryptocurrencies, the only way to really identify tops and bottoms is through something like this, which is market timing, our approach to market timing. So I think I digressed a little, but that's how these different indicators have evolved, and that's how they become widely used in the marketplace.
So you found that many of the traditional technical tools didn't always work as well as some simple adaptations would. Do you still use the classic forms of technical analysis such as chart patterns and trend lines? How do you trace a trend line, for example?
Well, the thing is, people use trend lines, but that's always been frustrating for me because they draw trend lines. I think it's just human nature. If you have a chart in front of you, you'll draw a trend line. You'll select the point way on the left-hand side of the chart and connect it with a fairly recent point and say, okay, here's my trend line. And if it doesn't work, the breakout or whatever, you'll adjust it. It's so subjective. So what I did with trend lines, for example, everything I did has been systematic and objective. I take the most current high, for example, for a downtrend line, and I make certain the day before or the bar before and the bar after is lower than that high. And then what we got is called the TD point. I mean, that was just labeled by one of the people who work with me. That's one of our points. Obviously, 2 points make a line. So we take that high, and then we go back in time to the most current prior high that surrounded bar before and bar after by a similar point. And you connect those two points to make your trend line. I always tell people trend lines are drawn from left to right, but technically, if you want to call it technically in the sense with scientifically, you would draw the most recent point and connect it to the next most recent point. And that way, your trend line is durable. It's long lasting. It never changes, and you'll have the same trend line regardless. Today, yesterday, you have the same trend line that other people are using, and it's not subjective. And if you want to have longer term trend lines, instead of having a TD point or a point surrounded bar before and bar after by one lower high, you make 2 or 3 or 4 lower highs before and after. That way it'll give you a longer term trend line. And one thing we found, if you draw a trend line properly, once you break out the trend line to the upside, for example, you can go to the lowest price beneath the trend line, take that lowest price as your reference, and then go immediately above it to the trend line. And because of the dynamics of the symmetry in market and human behavior, that distance there you could add to the breakout of the trend line to the upside. And that'll give you a price objective. So all our analysis with trend lines was based upon breakouts and price objectives. But one other thing that's really important, and it's important whether you use moving averages, whether you use trend lines, whatever you use, is that it's really important to have, once you suspect that the market's going to make a breakout, what we found is that if the market records an up close, the bar before an upside breakout, most of the people who are going to buy are already in the market. But if you have a down close before an upside breakout of a trend line or moving average, because people were most recently sellers, they're skeptical. So that's why if you look sometimes, before you break out above an important level, to retracement level, moving average level, the trend line level, if the bar before the upside breakout is a down close, the price bar, the breakout usually is suspect. They're suspicious to most traders, and they're skeptical. And as a result, the market on the breakout is usually on low volume. And then if you close above that breakout price, we have what we call the qualified break, but we wait for confirmation. And the confirmation of the breakout requires the next price bar to open higher and then close higher for the day, in this case for the daily chart, and also make a high above prior 3 bars highs. If that happens, you've got a legitimate breakout. So we've quantified everything. Instead of guessing, we make everything concrete, and we make it something that we can, always refer to in the future. So maybe I got too long-winded there, and I covered
No.
breakouts.
That's great. So you can continue that, because I will ask about it. You are known as a counter trend trader. So could you explain how to create a rules-based counter trend investment strategy?
Totally counter trend. Everything's counter trend. Just like if you were to go to Las Vegas, for example, the dealer works for the bank, they call it, for the house, and they're doing the opposite of what everyone else is doing. That's the way I operate in the market, and the reason for that is the way I was groomed, the way I was brought up in the business, and I was always conscious and cognizant of purchasing large positions, and you had to buy into weakness. And what happens if you're buying into weakness, you can buy as much as you want. Whereas if you make a market bottom and the market starts rallying, there's price gaps, on the upside. There's a lot of competition to buy, and you can never buy size. So everything I do is contra. Yes, and you can, but a lot of times if you go back to refer to the moving average breakout or the trend line breakout or whatever retracement breakout, if your day before an upside breakout, if you're on a daily chart, is an up close, and the next day you break out, more likely than not, it's going to fail. But if you have a down close the day before, it probably will be a legitimate qualified break, and you wait for the following price bar to confirm it. So you really could use a trend line instead of moving with the market's trend to the upside. If it's not qualified, the bar before is an up close, and then you get the breakout. You could almost sell that breakout point because it should fail. So that's the approach. Everything we use is against the trend. Even trend lines, moving average breaks, we operate against it. We look for the ones that are disqualified breaks, and we operate against it. Little too complicated, or no?
No. Can the use of market timing enhance macro investing? Do you think so?
What's that? What did you say?
Market timing enhance macro investing. I mean, macro timing. Market timing you could be a better fundamentalist trader or
as far as fundamentals, obviously fundamentals determine the long-term trend of any market. So fundamentals are important, but fundamentals will tell you what to do, what to buy, what to sell. But technical analysis or market timing tells you when to do it. So I took the chartered financial analysts. They were back in the early 1970s. You didn't have to take any exams, but they started with 3 exams. I took the exam 1, fundamentals, and number 2, but I never took the 3rd exam because I'm not. I didn't consider myself a fundamentalist. I consider myself a hybrid. I'll look at long-term movements and fundamentals, use a good research source, and I'll time it with the indicators I created. So I think you got to use a combination of both.
Nice. And Tom, do you think it is important to have discipline and use plan to control risk? How do you manage risk?
Well, here's the thing. My biggest flaw in my career is money management, because I got this perception everything I created is going to be 100%. And my whole goal has always been research. And if I could develop something that's had high, Sharpe ratio, high accuracy, I'm content, but I want to improve upon it. But in order for me to get really involved, and I almost had to have I think Larry Williams' son, who's Jason, who's a psychiatrist, will probably, describe me better. My goals are different. I mean, I have been successful financially. I'm at the point where, I can retire anytime we want. But I just have such a passion for the markets. My goal is more creating timing systems or timing indicators. And as a result, I'll go into a position 100%, and I'll hope, which is terrible to say, I'll hope that I have problems with the position, because that will encourage me to improve upon the indicators I create. So my goal hasn't been to make money. I have been successful in trading, but there's also other problems. The conflict of interest, if you're advising people, it's not worth the risk. I mean, back in 1977, 78, 79, I was consulting with most of the major people in the industry, and I had a reputation for identifying buyouts, for example. And there are a number. I could go through. There were 32 stock companies that were bought out, and the Wall Street Journal described me as the Grim Reaper, because I would have we were managing quite a bit of money, and I would notify different companies that you're going to be bought out. I'd say to their treasurer, president, and that was somewhat well known in the industry. And they say there's no way. I mean, when one company was Budd Company, BUDD, they manufactured cars for railroad. And I contacted them, and we were managing their portfolio. We said, "You've seen that we've had a number of buyouts in your portfolio." And I said, "Looks like you're going to be bought out." And they said, "No way. We know where all of our stock is in the United States." Well, they were bought by a foreign company. So they were surprised that, it was correct. Another company, which was local at the time, was Eaton, Cyrus Erie, and another company, two companies, and Color Hammer was the name of the company. We had the board of directors of the company in our office, and we told them, "Looks like your company's going to be bought out." And they said to me, "No, we keep good control on who buys our stock." And the only person who was silent at the time was the treasurer. Well, about 2 months later, they were bought out by Eaton Corp, and the treasurer of the company became the president of that division. So I was never ever, even though I had a reputation for identifying buyouts, I was never investigated. I know one other instance, Dean Witter. I got to be very close to the people at Dean Witter Brokerage House. I notified the fellow who was president, Stretch Gardner. I told him about it. Looked like Dean Witter's going to be bought out. And he said, "No, we don't see anything like that." And they were bought out. Morgan Stanley. And so you can use the data from the Wall Street Journal. I was using open, high, low, close, and volume, and I was able to determine, and we did a lot of calculations, and we were able to determine when a stock was selling off and was still being bought. And it was a derivation of something Larry Williams did with using the opening price as your focus, not the prior day's close. See, I think one of the big hoaxes that was perpetrated by the investment community, and I think it still should be corrected. I think you can adjust it on some quote monitoring machines, but just to use logic on this, if IBM, for example, yesterday closed at 150, and they announced after the close, they announced record earnings or some big announcement, and the stock went up 10 points. Then it closed at 150. It opened the next day at 160, but it were to close that day at 154, it'd still be up 4 points for the day versus yesterday's close, but it's down 6 points from the opening. So the reference point really should be the current day's open. And that applies to all markets. I mean, usually earnings are announced after the close or before the opening. So that impact is determined by the opening price. So the movement should really be from yesterday's, not from yesterday's close to today's close. It should be from today's open to today's close. So if you were to accumulate all those days that the market closed above its open or below its open, and there are other calculations involved. You take the range for the day and you allocate how much was buying pressure or whatever. You can come up with some good results. I mean, there's really no time for us to do it nowadays, and there haven't been very many buyouts, but it was really helpful. We found that markets that's how we came to the conclusion that markets bottom, not because of smart buyers. When people are buying at a market bottom, it's usually short covering. And when people are not buying at a bottom, that's usually when the market's bottom, because too many people are afraid. I think if you go, we've had a number of interviews, and we had an interview at the March low in 2020, the day of the low, and we said buy. And the reason for that is because everybody was concerned. Same thing happened in 1987. I mean, all these different turning points in the market, especially at lows, is when the market is exhausted. The selling's exhausted. So, but as far as what do I trade? I have money. I don't want conflicts. I don't profess to be a greatest money manager, but someone like Steve Cohen is, and I've got money with Steve Cohen. So I don't need to do it. I supply input with my research, but I don't care to manage money.
There's a statement that says, millionaires don't use astrology, billionaires do. And it's good to JP Morgan. So you work as a special market time advisor to the billionaire Steve Cohen, a role you have held for more than 20 years. Is it true that you have a special fund like Commissioner Borderline to Batman that can catch you anytime? So, do you know if he are in his plans to buy a Brazilian soccer team? There's one called Vasco da Gama with more than 100 years of history and has amazing 30 million fans like me. Okay, just kidding. So how is it work with a guy like Bruce Wayne?
I mean, I've been fortunate. And back in the 70s, I advised, there was only one hedge fund back then. It was Steinhardt. It was Steinhardt, Fire and Berkowitz back then. Mike Steinhardt was an excellent trader. I worked with a guy named George Henry, who was in charge of bonds there. Worked closely with him. I worked with Paul Tudor Jones. I was executive vice president with Peter Borsch at the company there. Leon Cooperman and I have been friends for 45 years, 50 years. Paul Jones, and then in 1979, 81, 82, Soros with his quantum fund. But I worked with people who worked with him. I've seen them all the traders, but no one is like Steve Cohen. No one. I mean, he's special. And he's able to ferret, to determine which indicators are valuable and when. And he's also got such experience and the sense for the market that it can't be quantified. I mean, everybody said, and I tell people this all the time, that Michael Jordan, the basketball player, could never teach somebody how to dunk. You have to have the ability. And like Steve, Steve can't teach what he has. I mean, when I was with Paul Jones, I know this is 40 years ago. No, not quite, 35 years ago. Artificial intelligence was a subject that Peter Borsch talked about a lot. And what happened, they had a group come in, and they claimed that they could mimic or they could clone Paul Tudor Jones. And I happened to be sitting there at this time. Excuse me. And they asked Paul, why did you take this buy? Why did you buy at the market? Buy this particular position. I don't know, it was cotton, sugar. I don't know what it was at the time, gold. And he said, because of this, this, and this. And he gave reasons why he bought. And then, I'd occasionally go to New York. I was living in North Carolina at the time, and I'd go back, and they were still there, quizzing Paul on why he's doing this and why he's doing that. And the next time I was there, he said to Paul, "Why are you buying here?" And he said, "Because of this, this, and this." And they said, "Well, this contradicts what you said previously. It's just the opposite." He said, "Well, that's the way I feel right now." So he really can't. He couldn't describe. I mean, for a computer, for a computer programmer, the specific reason why he's doing it. And that's the same way with Michael Jordan, and the same way with Steve Cohen. I mean, when I talk to Steve every day, he supplies me with fundamental justification or input why the market's going to do this or this and this, and he's got total control, or he's got total understanding of my indicators. And he's also got other indicators, and he's a computer himself. He's the best. He's the best. I think Larry Williams would tell you the same thing. But I've known them all. There's a fellow named Charlie DeFrancesca, who was the biggest trader on the Chicago Board of Trade in the bond pit. he was the same way. Charlie and I were the closest friends. I was leaving Tudor to join him. We were going to have a fund, and he Charlie was trading 100,000 bonds a day for his personal account, and I would say to Charlie would say to me, Tom, he says, I know when to buy and sell, but I couldn't do it for a living off the floor of the exchange. He says, I can feel things down here. He said, I can't tell you why I'm doing it. It's almost inspirational. It's part of my nature. And that's the way I describe it. And I found that most of the people who are excellent traders really don't have any emotions. I get very emotional. They don't get emotional. They really don't. I mean, there could be a car crash in front of them and they'll just shrug their shoulders. As long as, does anybody get hurt? No, that's a big deal. But I mean, they don't seem to care about, they're not influenced at all. And I think if you put a measuring something, if you were to measure the brain waves when something goes wrong, they just accept it. They adapt. If you want to use that word, they can adapt. You know, Larry Williams' son Jason could probably explain why, but it's just some people are born that way and adapt. They can accommodate and adjust to different unexpected events, and that's the way Steve is. I got nothing but respect for him. I mean, he apparently had some issues. At least people claimed he did, but I saw him. I spoke to him every day. Nothing like that ever happened. And he's a survivor. All these people are
as
survivors.
good as he is. He's the best, one of the best traders ever.
Oh, he is. Definitely. He is the best. He is. I've seen them all. I really have. I mean, some of them got reputations that are unjustified. They're great and this and that. I mean, they have one or two good trades, but he survives. That's the thing. He was. It's amazing what he does. I mean, he could tell me. I said, well, look, we got this and this happening right now. You ought to consider it. And he'll tell me. He said, well, this time it shouldn't work. Well, Paul Jones used to do that to me. I remember we had sequential in 1987, for example. I remember there was a trade, and the top of the market. If you take our sequential, just the basic sequential and combo, and you apply it to the Dow Jones average, and you'll see that the peak, August 26, 24, 26, 26, that particular peak, there was a 13. Okay, and then if you use Fibonacci, 55 trading days later was the October 3rd low. So you weave together Fibonacci 55. You could take the 9 and 13s that we developed. You could take combo. And you can get the August peak. The same thing happened excuse me. It happens over and over again. You'll get 13s, and you can apply other techniques to it too. But I know Paul said we had a sell signal on soybeans, and we had it on a number of currencies. And he said, how do you determine this? Is when we first got into this and the understanding of the indicators. He said, I want to know what happens when it doesn't work. That's his mentality. He doesn't assume everything's going to work. He says, what happens when it doesn't work? And I said, well, you have stop losses. You can call them risk levels. That's what we call them. And once they're exceeded, he said, what happens then? I said, they accelerate in the other direction. So, and that's something, some of your listeners could do as well. If you take a high on a chart, for example, and you take a high that's been a high for maybe, just to round it off, 89 trading days, the market had not gone higher. And 89 days prior had never gone higher, just to take a Fibonacci number. If you take the range that day, the price range from the high to the low, and if there's a gap, you take the prior day's close, and you add that high to that high, and once you close above there, and it's preceded by a down close the day before, you probably are breaking out in the other direction. And so whatever you sold, that's where you could do this with a 5-day high, an 8-day high, or whatever. Well, Paul said, well, what happens if you break this risk level? And we looked at it, and the market accelerates the other way. Excuse me. So he said, I'd rather take the trades that don't work because they move quicker, and it's against the trend. So that's his way of trading. That was his way of trading. I think he's a longer term trader now, but Steve's familiar with all that too. It's just when you get to the point you're managing $1 billion, $2 billion, $5 billion, you don't have the flexibility. I mean, a lot of these guys like to trade, but they're too big to trade, and they can only do a small portion of their funds. Now Steve's capable of trading. He concentrates on the big names, stocks or markets, and he's able to trade those and successfully.
You said in your award speech that when someone has a passion for something, it is something special and you want to do it regardless what you are paid. So Tom, please, what's your final advice would you give to younger traders?
Okay, I think one thing people alluded to, they asked me in my first book when I wrote, Larry Bird was a famous college basketball player at Indiana State, and then he went on to the Boston Celtics, and he's a legend. Larry Bird is. But when he was 1979, he was interviewed after he was drafted by a professional team, and he said, and I always look back at this and laugh. He said after he had signed his contract and everything, he said to the reporter, he said, "How do you feel?" He said, "I feel great." He said, "This has been my goal all my life." And he said, "What do you have to say to your followers, to the owners?" And he said, "I can tell you something now that I've signed my agreement." He said, "I love this game so much, I would play for nothing." He said, "I'm so obsessed with this." And that's the way I feel with the markets. I mean, I'd be doing this regardless. I mean, this is a vocation avocation for me. It's my hobby. It's my life. I mean, it's turned out to be my life. What I've told people, and I've gotten in trouble because I guess I'm notorious for speaking without a filter. I was giving a speech in California. This is more on the retail side. And I told people at a big conference, there were 6,000 people in the audience, and they were asking questions, and I'll take any question and I'll answer it. And someone said we were in an auditorium, and next door was where all the booths were for the different services, the vendors. They were selling things, and they said to me, the one person said, "What's your best advice you can give to all the people here?" And I said, avoid the room next to us, because you're going to be sold things that are useless. And I got in trouble for saying it, which is truth though. I mean, you got to find what you're most passionate about, and you got to be committed to it. And you can't be inspired by making lots of money. I think anybody who's really into something and is an expert at it, the money comes afterwards. So you can't go into a profession looking to make money. You want to go into a profession because you really love it, and it's something that will fulfill your life. And that's what's happened for me. And I've been fortunate. I mean, nobody's had the opportunities I've had. I was in the institutional side of the market when it was growing. I've had relationships on the retail side of the market. And most people are compartmentalized. They're solely institutional, they're solely retail. I've also focused on stocks, and I focused on commodities. Futures. I was one of the first people. I bought an exchange on the Chicago Board Options Exchange. Seats were for $10,000 back in 1972, and they started trading in 1973. I bought 2 seats or 3 seats, but when my company found out, they said, "Oh, no, you can't do that. You got to turn them back. It's too speculative to buy options." So I never executed it. But that's something that I was always interested in something related to what I was doing to expand my my knowledge, and that's what I did. So giving advice to people, I tell you, it's difficult. I think Rod and Chris, who are listening right now, they'll tell you the same thing. People ask me, they want to trade markets, and they said, "What advice can you give us?" And I tell them, if you got a full-time job, I said, you got 2 options: either be a long-term investor using technical analysis or market timing, I would suggest, or take up another hobby, stamp collecting or model trains or something like that, you're going to end up losing. Unless you're full-time, I've seen the people you're competing with. And these people are geniuses. And they've got resources the average investor doesn't have. So I think it's like trying to win the lottery. If you're not prepared and you just throw money at the market, you might get lucky, but it's not a long-term successful path.
Nice. What a great advice. And we come to an end of this astonishing interview with Mr. Thomas DeMark. We want to thank you all, our viewers, for joining us on this journey.
And you also want to thank you, Tom, and of course your wife, Nancy, for sharing your great histories and remarkable achievements with us. We hope that your accomplishments and dedication inspire traders around the world. Thank you, Tom.
Okay. Remarkable. Thank you very much. Bye.